Google just reported earnings per share of $9.11 against $2.31 a year ago. That looks like profit almost quadrupling. Revenue beat. Cloud grew 82%, and the stock fell because $99 billion of that profit was not cash, was not operations, and may not survive the next quarter. This is the single best example I have seen of why the headline earnings number can be almost meaningless and how to find the real one. Before we start, the usual and important housekeeping. I am not a financial advisor. This video is for education and entertainment only. Nothing here is investment, tax, or legal advice, and nothing here is a recommendation to buy or sell any security. Investing involves risk, including the loss of your capital. Past performance does not guarantee future results. I may hold some of the assets discussed. Always do your own research. Welcome back to The Silent Investor, where we go deep. No hype, no price targets, just the mechanics underneath the headline. Today, we are using Alphabet's second quarter to learn something that will serve you for the rest of your investing life. How to tell the difference between a company that earned money and a company whose accounting says it earned money. Those are not the same thing, and this quarter shows the gap perfectly. Here's what got reported. Alphabet posted revenue of $119.8 billion for the quarter, up 24% from a year ago, ahead of the roughly $117 billion analysts expected. Net income available to shareholders came in at $112.1 billion against $28.2 billion a year earlier. Diluted earnings per share of $9.11, up from $2.31. On the face of it, one of the most spectacular quarters any company has ever printed. Except $99 billion of that came from a single line called other income. It is a net gain, and it is described as primarily unrealized gains on equity securities. Unrealized, meaning nothing was sold, no cash arrived. Alphabet holds stakes in private companies, and when the estimated value of those stakes goes up, accounting rules require that increase to flow straight through the income statement as profit. It is a valuation adjustment wearing the costume of earnings. This is not Alphabet doing anything sneaky, and that matters. It is required. Under the current accounting standard, changes in the fair value of equity investments run through net income each period, rather than sitting quietly in a separate reserve as they used to. The intention was transparency. The side effect is that any company holding large equity stakes now reports earnings that swing violently with the estimated value of those stakes, quarter to quarter, whether or not anything was bought or sold. So what did the business actually earn? Strip out the non-operating noise, and adjusted earnings per share were $2.85. Analysts were expecting $2.89. So the real operating number was very slightly amiss. Sit with the size of that gap for a second. The headline said $9.11. The operating reality was $2.85. Anyone reading only the first number would have concluded something wildly different from what actually happened. This is the habit worth building. When you see a net income number that looks impossible, go straight to operating income, because operating income only includes the actual business. Alphabet's operating income was $40.8 billion, up 30%, with operating margin expanding 2 percentage points to 34%. That is genuinely excellent. It is just a completely different sentence from profit quadrupling, and it is the sentence that is true. Now, the part of this report that deserved the headline. Google Cloud revenue grew 82% to $24.8 billion. Look at the trajectory rather than the level. 48% growth in the fourth quarter of last year, 63% in the first quarter, 82% now. That is a large business accelerating, which is rare and hard because growth rates normally decay as the base gets bigger. Cloud operating income roughly tripled to $8.8 billion. It is not just growing, it is growing profitably. And there is a number underneath that which I would argue is the most important figure in the entire release. Cloud backlog reached $514 billion. Backlog is contracted revenue that has been signed but not yet delivered. It is the closest thing an investor gets to visibility into the future. because it is money customers have already committed to spending. Revenue tells you about the quarter that just ended. Backlog tells you something about the quarters that have not happened yet. But let us be honest about what backlog is and is not, because the number gets quoted carelessly. Backlog is contracted, which is far stronger than a forecast. It is not, however, cash in the bank. Contracts have terms, and they can stretch over many years, so a very large number can convert into revenue slowly. Some agreements can be renegotiated or cancelled under certain conditions, and a backlog concentrated in a handful of enormous customers carries very different risk from one spread across thousands. So treat $514 billion as strong evidence of demand and much weaker evidence of timing. It tells you the direction with real confidence. It tells you the date with very little. The core business held up too, which was not guaranteed given how much people have worried about AI eating search. Google services revenue rose 15% to 94.5 billion. Search and other grew 17% to 63.3 billion. YouTube advertising rose 13% to 11.1 billion, ahead of expectations. The thesis that AI answers would cannibalize search advertising has not shown up in these numbers yet is doing real work in that sentence, but the data so far says the engine is still running. So why did the stock fall on all that? One reason. Capital expenditure was $44.9 billion in the quarter, roughly double a year ago. And management raised full year guidance to between 195 and $205 billion, up from 180 to 190, while signaling that next year would be higher still. That is not a rounding error. That is a company telling the market its costs are going up faster than the market had modeled, and the consequence shows up in exactly the same place it did at Tesla the same evening. Free cash flow was negative $5.9 billion because spending on property and equipment outran the cash the business generated. Alphabet also raised money to fund it, issuing roughly $49.6 billion of stock in June, plus $20.3 billion of senior notes. One of the most cash generative businesses ever built, spent a quarter cash flow negative. That is what the scale of this build out looks like in the accounts. And there is a consequence of that spending which almost nobody discusses. Capital expenditure does not hit the income statement all at once. The cash leaves now, but the cost is recognized gradually as depreciation over the useful life of the equipment. So the $200 billion being spent this year becomes an operating expense that presses on margins for years afterwards, whether or not the revenue arrives on schedule. And there is a second wrinkle worth knowing. Companies estimate how long that equipment will last, and lengthening that assumption spreads the cost more thinly and flatters near-term profit. It is a legitimate judgment, not a trick, but it is a lever, and it is worth knowing it exists when you compare margins between companies. Here is the genuine disagreement, and reasonable investors sit on both sides. The bull case is that this spending is demand driven, not speculative. Cloud is accelerating, the backlog is enormous, and if customers are contractually committing, then building capacity is simply meeting orders. The bear case is that capital expenditure is certain and immediate while the returns are estimated and distant, that depreciation from all this hardware will weigh on margins for years, and that the whole industry is building at once. Both readings are defensible from the same report. And zoom out because this is not really an Alphabet story either. On the same evening, Tesla reported its own record revenue, its own enormous increase in capital spending, and its own negative free cash flow. Its shares fell too. Two completely different businesses reporting hours apart, telling the market the same thing. We are spending enormously right now on infrastructure we believe we are going to need. Amazon has guided above $200 billion as well. When an entire industry builds simultaneously, the risk is not really that any single company is wrong about demand. It is that they are all right about demand and all wrong about how much capacity that demand actually requires. So the transferable checklist, which works for any company. One, if net income looks extraordinary, find out where it came from before you believe it. Two, read operating income because it excludes investment gains and one-off items. Three, check free cash flow because cash is much harder to dress up than earnings. Four, look for forward-looking evidence like backlog, deferred revenue, or subscriber counts. Five, read the guidance, not just the results, because markets price the future and the guidance is the future. That is where the stock reaction lived this quarter. So, what would settle the argument? Five things, all checkable. One, cloud growth. 82% is exceptional, and the only question is whether it holds. Two, cloud operating margin, because growth that arrives with expanding margin is a completely different asset from growth bought with discounts. Three, backlog and whether it keeps building or starts converting into revenue. Four, free cash flow and whether negative was a one-quarter spike or a new normal. And five, the capital expenditure guidance itself, because management already signaled that next year would be higher, and the market has just shown you exactly how it reacts to that number. The takeaway: Alphabet had a genuinely strong quarter, revenue beat, operating income up 30%, margins expanding, a cloud business accelerating to 82% growth with a $500 billion backlog behind it. And the headline earnings number was still mostly an accounting artifact, while the market sold the shares anyway on the cost of what comes next. Great business, real acceleration, misleading headline, and a very large bill. All four of those are true, and you only get to see all four if you read past the first line. If this changed how you read an earnings headline, do me one small favor. Tap like. It genuinely helps more investors find this. Share it with someone who saw $9.11 and thought the story was over. And subscribe because we do this properly every week. We do the digging so you do not have to guess. See you in the next one.